Short exercise 14-8, bond issued at premium. So Wilkes Mutual Insurance Company issued a 100,000 5% 10-year bond payable at 111. So they issued this at a premium. We can tell it's a premium because the issue price is 111% instead of just 100%. Interest, as always, is paid semi-annually, and it's going to be paid on January 1st and July 1st. So our first requirement, journalize the issuance of the bond payable on January 1st. So we know we're going to get cash because that's why we issue bonds. But how much cash are we getting? To calculate that, you're going to take the $100,000 par value and multiply it by the price, which is 111%. When you do that, you get 100,000 times 111%, or 100,000 times 1.11 gives you $111,000. 111, comma 000. Copy and paste that. Plop it into the credit. Well, we can't do that yet. Getting ahead of myself. We also know that we have a bond payable. We're going to have to pay this in 10 years, and the amount we have to pay is the par value, 100,000. Now you may notice, put the comma in there to make it easier for you to read, this does not balance. So we can calculate the balancing amount and plop it in there. So to get the balancing amount, you take 111,000 minus 100,000 gives us 11,000. So now both sides balance. Debits equal credits. But what is this account going to be called? Well, notice, remember that we issued this bond at a premium. So this is called a premium on bonds payable. And then we need an explanation, issued bonds at a premium. That's fine and dandy. Now we're going to journalize the payment of the semi-annual interest and amortization of the bond discount or premium. So this premium needs to be gotten rid of over the life of the bond. Why? Because when we pay off this bond, we need to lower this by 100,000, and then we need to lower cash by 100,000. So at maturity, the transaction would look like this. We get rid of bonds payable, and then cash goes down. Well, notice this transaction balances. There's no room for anything else. So you would be leaving this $11,000 premium on bonds payable on your books, but the bond would be gone. So the rule is, over the life of the bond, we have to slowly get rid of this $11,000. And that slowly getting rid of it or slowly decreasing it is also called amortizing. So we're going to amortize this bond over this premium over the life of the bond. So how do we calculate the, well, first of all, how do I get rid of this premium? Am I going to debit it or credit it? To get rid of this premium, you need to debit it. So we need to take this 11,000 and divide it over 10 years. And then divide that by 2 because because the time that we amortize this bond is every time we pay interest on the bond. And how often do we pay interest on the bond? Every 6 months, twice a year. So here's how we calculate the amount of amortization. You take the $11,000 premium, divide by 10 years, and then divide by 2. So it gives you $550 premium. So $11,000 divided by 20, basically. So we need to amortize that by $550. We also know, because remember, this is the payment of semi-annual interest, we need to pay cash. So I'm going to skip a line, and you'll see why in just a bit. And cash is going to go down, so we have to calculate the cash amount. So the formula is principal times rate times time. So we have 100,000, which I get from here, times 5%, 0.05, which I get from here. And it's paid every 6 months So you multiply by 6 divided by 12. So it gives us an interest payment of $2,500 for cash. You could also just multiply 100,000 times 5% and divide by 2. You get $2,500. So we're going to shell out $2,500 every 6 months. Now notice this does not balance. Well, of course not. We need some interest expense because that's what we're paying, interest. And that's going to be an expense for us. And we know interest is increasing, so the expense has to be on the debit side. So that's going to be the balancing amount. So to calculate the interest expense, you just take cash, $2,500, minus $550 gives us $1,950. So double check your work, add $550 plus $1,950, and make sure it equals $2,500. So then we need an explanation, paid semi-annual interest, and amortize the premium. So as you can see, by issuing the bond at a premium, it has lowered our interest expense a little bit. Normally, if this bond had been issued at par, the interest expense would be the same as the cash, $2,500. But because we issued the bond at a premium, it lowers our interest expense, which in effect will increase our profits, but also increases our taxes. And that's it.